And let's begin. This is Pacific Trading Academy's presentation of me, Mike Bridges, and my POV RWB trading technique. Today is Saturday, March 22nd, 2014, and it's about 9 a.m. Pacific time. POV RWB stands for Price Oscillator Volume Red, White, and Blue. Okay. Now, for those of you who don't know me, I am a retired California lawyer specializing, or previously specializing, in financial planning. I have held the following FINRA licenses: Series 3, which is Commodity Futures and Options; Series 7, General Securities; Series 66, Investment Advisor, and I've also held some insurance licenses here in California: Life, Accident and Health, Variable Contracts. I have been trading all sorts of different things since 1984, and I've been mentoring other traders in stocks, futures, and Forex since 2000. If you can do the math in your head, that means I've been trading for 30 years and teaching for 14. I've also been an NFA CFTC registered commodity trading advisor since 2003. My favorite method in market is to day trade the S&P E-mini. My favorite platform is NinjaTrader 7, and my favorite broker is a gentleman by the name of Trenton Kimino at Global Futures in Encino, California. I'm a member of LinkedIn, and if any of you are LinkedIn folks, you can find me there. Check out my profile. I usually post updates on an almost daily basis of things regarding my trading or upcoming webinars and such. So if you're interested in keeping track of what's coming up on the Pacific Trading Academy schedule, this is one place you can find it. Another place is the actual Pacific Trading Academy website at pacifictradingacademy.com, and I have a blog page there, and you get to it as follows. Let me turn on my little spotlight here. If you go to the blog link and then Mentor Mike's Market Movie, you'll see plenty of issues of movies and screen captures and essays on trading related topics and whatnot, and it's all free of charge. You don't need any special access to get there, so avail yourself of that when you can. And now let's see. One problem is when I'm in drawing tool mode here, it doesn't like to advance the slide, so bear with me a second. Okay, now let's get into the heart of the matter today. How do you eat an elephant? That's a funny question, but I bet you've probably heard that riddle before or something like it. How do you eat an elephant? Well, the answer, of course, is one bite at a time. Any large task, like learning to trade, can seem overwhelmingly difficult at the outset, but the key is to break it down into manageable chunks and then just get started. We can apply this proven technique when attempting to make sense of the chaotic motion on a price chart. Here's another analogy, an assembly line analogy. The indicators on my charts are a little like an assembly line. Factory workers perform their unique tasks that combine with the other elements and ingredients to create the finished product. In my case, each of my indicators reveal part of the puzzle of price direction, and together they create the finished prediction with the highest probability of success. There's also a Wheel of Fortune analogy. The indicators on my charts are also like a game show puzzle. On Wheel of Fortune, contestants reveal letters that make up a familiar phrase until they have enough clues to solve the puzzle. Each of my indicators reveal more letters until we can see that they spell out, for example, a bearish wave 3. I'd like to buy a short trade, Pat. Now, let's start dealing in some more practical terms. This is my basic chart template that I have been using of late, and this is a 1-minute chart of the S&P E-mini from yesterday, Friday the 21st of March. Now, to some of you it may look overly cluttered. To others it may look woefully sparse, and that's okay. As long as you get the job done, it doesn't really matter how you get there. But everything on there makes sense to me and has meaning. And I want to take you through that process so that you'll understand as well. You may decide that you like doing things the way I do, and that's great. You might decide that you like a different color scheme, or there's a different combination of indicators that you want to use, and that's okay too. What I do think is important is for you to get the underlying concept, which is we need to take this mass of information and somehow make sense of it. And one of the best ways to do that is to chunk it down into little modules of movement and momentum that we can then look at as pieces of the puzzle and then put it all together. So let's begin by concentrating on panel number 1. Now, I have done other webinars in the past where I've spent more time on oscillators and volume, and we'll definitely be touching on those topics, but I want to spend a little more time today on price and on the color coding indicators that I like to use, and that's where the red, white, and blue comes in. So here's our panel number 1, and again, it might look a little crowded, but what I'm going to do is I'm going to get down to the bare price bars, and I'm going to put everything back one thing at a time so you can kind of see where my head is coming from in terms of what these tools do and how they all work together to get the job done. So here's our price bars. Let's start out by answering this question, which might be on some people's minds. Why not Japanese candlesticks? Well, I do think that Japanese candlesticks are probably the best charting method out there because they give us more information than a mere price bar. The problem is this. If you're a position trader, candlesticks are great. But if you're a real-time trader, a day trader, they have a couple of drawbacks. One is that to make them look decent so you can see each individual candlestick, you got to kind of spread your chart out more. Otherwise, they get all jumbled up and you can't really tell what's going on. By spreading out the chart, we look at a smaller chunk of movement, and sometimes seeing the bigger picture can be helpful in figuring out where you are on the map. So that's one problem. The other is that some folks get too fixated on those big, pretty, colorful candlesticks. I still think they're the best way to go for position traders because there you're largely looking at static charts that are pretty much frozen in time, and you have plenty of opportunity time-wise to include candle patterns in your overall analysis because time is not of the essence. But in real-time trading, it's hard to worry about whether or not you've got an engulfing pattern or an evening star and all that sort of thing. And in addition, some individuals really can get a little overly concerned with candlesticks. You've got this, big colorful candlestick that's going in the wrong direction, and some people panic and they'll bail out of a perfectly good trade simply because one candlestick is kind of moving in the wrong direction. And of course, the minute they do that, the price steps back on the path and goes the way that their other indicators were predicting, but it's too late at that point. So when I day trade, I rely on the other indicators more than the price bars themselves. And so for me personally, I like to use these monochromatic price bars because even though all of the information that creates the indicators is here before us, it's the indicators that I tend to rely upon because there's the price contains not only the important stuff, but a whole lot of irrelevant static and noise as well. So here we are. We can see that we've got something going on. We've got kind of a zigzag on the left-hand side before the market breaks into a big sell-off. So let's start putting things back and making sense of this. The first thing I want to add is my trend-defining moving average. And let me pause just for one moment here. I have the little presenter's control panel closed, so if you guys are writing questions, I'm not going to see them anyway. If we have questions, if we have time at the end, I will be happy to take some questions. I'm also going to give you my email address several times throughout the program, so if for any reason you have a question that doesn't get answered, by all means send me an email and I'll do my best to get back with you through that medium. So in any event, what I have added is a simple moving average of the closing price, which I refer to as my trend definer. Now, normally I don't get into a lot of specific parameters because that's kind of a proprietary thing reserved for students, but I'll share this one with you because I think it's pretty important. It's 144 bars, okay? And not only is that a Fibonacci number, but this is almost magic in the sense that it seems to work as a good trend definer on virtually every time frame that I have applied it to, from 1 minute up to monthly and beyond. It seems to reveal the larger trend in any market. It uses, it will serve rather as a point of support and resistance frequently. And one of the things that happens with the trend definer is that when it is basically going in a horizontal fashion, I don't know if you guys can see my regular cursor here, so let me put the little spotlight back on. When it's going more or less horizontal, what the price tends to do is sort of oscillate around it. Now, you can use various analogies, like a pendulum swinging back and forth across a center line, or a rubber band being stretched in one direction and snapping back into the other direction. It doesn't really matter how you like to think of it. But when the market is in some sort of transitional phase, this will tend to happen. The trend definer gets more or less flat, and the price tends to swing around it in essentially equal swings. Now, one thing that would help us realize that maybe this breakout is going to be genuine is that we have a 1, 2, 3 top formation. And those of you who've heard me speak before might recall one of my old mentors, Ken Roberts, took a page from Charles Dow. Charles Dow called this pattern a failure swing. Ken used to call it the 1, 2, 3 top. And basically what happens is you have a high, that's your number 1 point. You come down to a sell-off, that's your number 2. Then the market rallies up again, but it doesn't take out the previous high. It falls a little bit lower than that. That's your number 3 point. When the market goes down from there, there's a high probability that it's going to keep on going. And that probability really starts picking up momentum when we bust past the number 2 point, which would have been at about this level here. So we got a 1, 2, 3 top formation. We also might have a wave 1, wave 2, down to wave 3 formation for those of you who are more into the Elliott wave thing. But in any event, the idea is that when the market lacks direction, you're probably going to have the price sort of undulating around a more or less horizontal trend definer, and then when there's a genuine move, the price will tend to stay on one side or the other. In this case, we obviously have a sell-off with a downsloping trend definer. All right, now let's see what we add next. This second moving average, the white one, I call the directional MA. It's obviously a lot shorter than the trend definer. And it too has a parameter that is a Fibonacci number, and it was very carefully selected because, as you can see, when the price tends to acquire some directionality, it will tend to be above the white MA when prices are rising and below when they're selling off. And I pay pretty good attention when I'm trading to not only the slope of the MA, but also the curvature at the turning points. It's not unusual to see that the price may break below, in this case, the white MA. But what will happen is it'll tend to consolidate for a while as the MA reacts to the price. And by the time it kind of reaches that tipping point and is ready to, turn the corner and start heading downward, that's when the price tends to break this little zone of support that it's established and really takes off as well. You can see it over here. The price comes up, doesn't quite reach the white MA, comes down, futzes around, breaks above it here, but it's not really until you start getting the curvature that it takes off to the upside. And you can see that pretty much all over the place at those turning points. So that's another helpful thing. So we've basically just added 2 lines here, and already we're making better progress on predicting where prices are likely to go. The next MA that I have created here is the, we could call that the price substitute. It's a navy blue MA, which is, of course, the same color as the price bars, but it kind of takes that fuzzy, zigzaggy, feathery-looking batch of price bars and gives them a little bit of, directionality there. So it's kind of like the spine on a feather, you might say. And now we can really kind of see the swings that we want to trade. When I trade in this configuration, essentially what I'm doing is I'm long when the blue MA is above the white one, and I'm short when the blue is underneath the white one. And there's more to it than that, obviously, but in essence, those are the swings that I look to trade. Now, in this slide, what I've done is I've added a Donchian channel named for Richard Donchian, its creator. Let me get my spotlight back. Now, the parameter of the Donchian channel is the same as the length of my white MA. So you can see the white MA is more or less running down the middle of the channel, kind of like its backbone. And what happens here is when the price rises, it pushes the upper channel line along, and then when it tops out and comes back down, the channel line will keep moving sideways until it runs out of parameter or until it's pushed higher by the price, depending on what happens first. And when it runs out of parameter, it starts to stair-step its way down to the successive highs until it catches up to the price again. So some people think that this is a little bit of added clutter, but I find it to be pretty helpful. And here, for example, the price rallies up, and then as it recedes away from that upper Donchian channel line, already I'm thinking, okay, is this the top? Is this the high? Is this thing going to keep going? Now, if the blue crosses the white before going higher and hitting that upper Donchian channel, then there's a pretty good chance it's going to keep on going. And that gets bolstered if the price gets far enough down to where it starts to then push the lower Donchian channel further down. So you can see as the price broke up here, it starts pushing the Donchian channel up. And of course, the bottom Donchian channel starts stair-stepping its way up. And at this point, the price catches up to it and begins to push it down again. So we've got a couple things going on. We've receded away from the higher line, made the cross, and now we're pushing the lower channel line down. You can see that all over the place. Here's an apparent low. Donchian channel goes sideways, starts to move its way up. In the meantime, before it does, the price crosses the blue, or blue crosses the white rather, and at this point we start pushing the upper Donchian channel higher. And so we've got a couple of ways that it can assist us. Now, some people find they don't really use it that much, and if that's the case with you, then you're better off to leave it off the chart because it's just an extra set of lines that you don't need. But in my case, I find that it definitely helps from time to time. So that's what that's for. Whoops, excuse me. Now I've added my beloved parabolic SAR, specifically the faster red version. Now I have created my red, white, and blue momentum modules. And for those of you who are not familiar with the parabolic SAR, it is an indicator created by Wells Wilder. It was introduced to the trading world in his book, New Concepts in Technical Trading Systems, back in 1978. It mathematically perceives if the price is going up or down. And if it's going down, as in this little module right here, what happens is once the price crosses the line from the previous module, the parabolic jumps up to the highest high of the previous series and then starts counting down from there. And then eventually the price will cross the line once again, and when that happens, it jumps to the lowest low of that series and starts to count off on its way up. Now, it's called the parabolic because if you had a long enough descent or ascent of the price at, say, a 45-degree angle, and the price just kept moving consistently at that angle, the parabolic would eventually catch up to the price because it's designed mathematically to create a parabolic arc. What happens in the real world, though, is not only does the parabolic gradually get closer to the price, but inevitably the price starts losing momentum in whatever direction it's going, and it will eventually turn in the other direction and bump into the parabolic. And when that happens, off you go in the other direction. Now, I have done my best to adjust the parameters on the red parabolic so that it will change direction at or about the point at which the price crosses the white MA. Now, sometimes I'm right on the money, like this one right here. You can see the price pops above the white, and then at the point where it brings the blue MA above the white MA, that's also where the parabolic flips. We get that quite a bit, but it's not always perfect. Here you can see the parabolic flipped a little bit early, and the crossing of the blue and the white happened a few bars later. But in general, that's okay, because it either gives you a kind of an early warning to be on the lookout for the crossover, or it all happens together. But I refer to these little chunks of movement that are segregated by the parabolic as momentum modules. And if you have red, white, and blue from the top down, that's a bearish module. If you have red, white, and blue from the bottom up, you got a bullish module. And again, why red and white and blue? Well, those of you who've seen other presentations by me may have heard that story before. I like the idea of three indicators pointing in the same direction. You're sort of getting an alignment of momentum on multiple time frames that way, the old tide, the wave, and the ripple. I particularly like the red, white, and blue because they are easily distinguishable from one another. They stand out nicely on my neutral gray background. And here in America, where our flag is red, white, and blue, we are sort of pre-programmed to always think of the colors of the flag in that specific order. If you ask anybody, name the colors in the flag, everybody says red, white, and blue. It's really, really strange to even hear those colors put together in any other order. So since we're kind of pre-programmed to think of them in that order, why not use that pre-programming to our advantage? So we look for alignment of the red, white, and blue, either bearish or bullish. Now, I've added a larger parabolic. Now, most of what you see on this chart panel is based on 1-minute data. There are two things that are actually based on 5-minute data. One is the trend-defining moving average. I said it was 144 bars. It would have been 144 bars if it was based on 1-minute data. If it's based on 5-minute data, it's 34 bars. The other thing that's based on 5-minute data is the big parabolic. And I have sort of purposely made it this sort of pale blue so that it's there, you can see it when you kind of want to look at it, but it doesn't intrude too much on the red, white, and blue modules created by the faster parabolic, because that's where we're really trading. That's where we're looking for the entries and exits. And this just kind of helps us see the bigger picture. And in general, I told you before, the red parabolic tends to flip when the price crosses the white MA. The big parabolic, the 5-minute parabolic, tends to flip when price crosses the trend definer. Now, in this little momentum module, it worked really well. You can see the price breaks above the trend definer, and we go from bearish to bullish. It comes back down, crosses the trend definer again, and boom, there goes the parabolic. Here, not so much. It broke above, almost in the middle, but then it kind of came back down again before finally going up high enough to cause the parabolic to change. Here it was a little early as well. When the swings are that fast and forthcoming, it can kind of detract a little bit from its alignment with the crossing of the trend definer. But in general, that's what we're looking for. So when we have a swing on the north side of the trend definer, you can pretty well bet you're going to have a large bullish parabolic. And if it's on the south side, you're going to have a bearish one, and so forth. Now, the name of the indicator, again, is the parabolic SAR. Parabolic because it is mathematically programmed to describe that parabolic arc. The SAR part stands for stop and reverse. And by that, we mean that it's always on. It's either in its bearish mode or its bullish mode. It's never in a neutral position where it's not on the chart. So this is essentially what I have in my upper panel on one of my more favorite chart templates. But again, there's a whole lot of ways that you can set these things up. So let's look at some variations. Now, one of the first things I did here was I got rid of the Donchian channel. And here you can see I've made the trend definer the red MA, and then we've got blue and white MAs here, and we've just kept the big parabolic but not the smaller one. So now we have these larger chunks of apparent movement moving around the red trend definer. Maybe this looks a little more appropriate for you. Here's another version. We could call this sort of the chaos version, because notice the moving averages are much tighter. Again, all the parameters are always Fibonacci numbers. The parameters for this set of red, white, and blue MAs, however, I call it chaos because it was specifically taken from a book called Trading Chaos by a fellow named Bill Williams. And you can get the parameters from Bill's book. And here's perhaps the simplest of all. We've got a red large parabolic and just the white and blue MAs. Now, here's what I really want you to pay attention to. Notice that within every one of these parabolic momentum modules, there is a highest high or a lowest low. Now, this is true not only of the big ones, obviously, but the smaller ones as well. So on any time frame that you use this indicator, within every bullish module, there will be a highest high somewhere. And within every bearish module, there will be a lowest low. Now, here we have a little tweezer bottom here. We have a double bottom. You can have that, obviously, but there'll always be a lowest low. There might be more than one, but you're always going to have it. Here, there's the highest high, and so on and so forth. Now, this is an important point because it's a cosmic truth of trading. A cosmic truth of trading, that's a little phrase that I coined, is an unquestionable fact about which we can truthfully use the words always or never without exceptions. Every parabolic SAR momentum module will always have a highest high if it's bullish or a lowest low if it's bearish, and there will never be an exception, and that's a fact. Now, in general, we select a time frame to watch that is going to keep us in our comfort zone. And then we trade between those highs and lows. Now here I've marked the highest highs and lowest lows visible on this particular chart with the little gold dots, and also these arrows. The lowest lows have green arrows, the highest highs have red arrows. And basically, here's something I want you to think about. The price starts to go up the minute it stops going down. It's another cosmic truth of trading that an essential element of price movement is that it's always oscillating up and down on every time frame. And you can see from this low to this high, look at all the little zigging and zagging that the price did. It does that on every single time frame without exception. And so what we want to do is find these turning points. And when we find a low, we want to be long. And we want to ride that trade up to the next high, take our profit, and turn around and ride it on back down, because that's what the market does. So as soon as it stops going down, it starts going up. As soon as it stops going up, it starts going down. And that's perhaps sounding overly simplistic and, you know, might fly in the face of some of the admonitions that you've heard in the past, you know, never try to pick tops and bottoms. But you know what? That's what we all do. Maybe we're not supposed to, but that's what happens. We're trying to find the turning points of the price so that we can get on board a particular move at the earliest possible time, because that's where you stand the best chance of success. And I'll tell you, some of the worst losses I've ever had have been due to re-entering moves that are already in progress. One of the little euphemisms I occasionally use for that phenomenon is that I'm trying to chase the train after it's left the station. I would much prefer an aggressive entry of a brand new directional move than to try and re-enter after the move is underway. So, like it or not, we're all picking tops and bottoms, folks. That's what trading is about. Now, how do we know when these tops and bottoms are really in? Well, one of the tools that we can use is a drawing tool. You can differentiate between drawing tools and indicators if you want, but they're all kind of on the same par. They're technical tools, if you will. Excuse me. And one of the things that can be helpful is the Fibonacci retracement grid. Now, I've applied it to this big long move here. The idea is we want to find out how far down is this thing going to go. Well, the way you would do that is you'd start drawing the grid from the last previous low. In other words, the turning point of the same type. So this is, we're trying to find out where this low is going to bottom out. So we start from this low that's already finished, and we draw it up to the last previous high. The grid in turn draws itself here, and as you can see, these are all the standard Fibonacci levels that any source book on Fibonacci will tell you about. 38.2, 50%, 61.8, 78.6, 100%, 127.2, 161.8, 200. This is 261.8. There's a 361.8 that is further down off the chart. And what you'll find virtually every single time is that these various areas are going to act as support, resistance, little tubes of consolidation. And one of the things we look for is when the price really stalls out once and for all, it's probably going to be at or a little beyond one of these standard areas of Fibonacci retracement. We'll talk more about that in just a second. Another great tool is the regression channel. We draw the regression channel from between a low and a high within a module, and we find that when the price breaks out of that regression channel, it's probably headed in the other direction. So it breaks out of this upward one and down it goes. It breaks out of the downward channel, up it goes, and so on and so forth. Now, what is a regression channel? It's a drawing tool, and it's consisting of 3 lines. In this case, the center line, which is the magenta colored line, you can kind of think of it as a self-adjusting moving average of sorts. You start from a particular high or low and you draw it towards the opposing high or low. And what it does is the platform reads the price data that is underneath the line as you're drawing it. And it tries to reposition the line so that's essentially in the middle, but in the mean, in other words, between lowest lows and highest highs as the price goes along. And it accumulates that calculation as it goes along. And what you'll find out is that when you go from low to high or vice versa, most of the time you're going to have the entire move fit within the regression channel. And the regression channel will shrink or expand to accommodate it. But it'll really help you see what's going on, and when there is a genuine breakout of that channel, that's when you want to pay attention. Now, this was my personal trading from yesterday, Friday the 21st. And I'm on a new goal where I'm seeking to make $1,000 a day, and I'm looking to form a group of traders who are my students that we're going to call the Grand a Day group. So I'm practicing ahead of time to make sure that this is a doable thing given current market conditions. So yesterday I took just 2 trades on this platform. Got long here at about maybe 6:15 and hit 3 targets. Got short here and hit 2 more targets, and together with my 9 contracts and 3 target strategy, I netted $1,104.50, and that score is exclusive of a $6 per contract transaction charge. So at that point, I quit trading my personal account and switched to the demo account that I use in the trading room with my students. But what I want to do first, though, is show you what my thought processes were in taking these 2 trades. Okay. Now, one of the other cool things about momentum modules created by the parabolic SAR is that they can often help us see the Elliott wave pattern. Now, let me clarify my position with respect to Elliott wave. I believe that there is an objective reality to Elliott wave. I think the market really does move in the patterns described by Elliott wave theory. However, I am not a fanatic about it, and there is information in some of the most typical source material that is in error. For example, one of the supposedly carved in stone inviolable rules of Elliott wave theory is that wave 4 shall never impinge on the price territory of wave 1. Well, in this particular example, it doesn't. You can see wave 4 stops here and wave 1 starts somewhere further down. However, that is not really a hard and fast rule at all. And even Bob Prechter, the #1 Elliott wave guru, admits it in his book, Elliott Wave Principle. And I have my copy right here, and I've marked this page with my little post-it note. And I want to read something to you, because invariably when I talk about Elliott wave, if any of my wave 4s happen to overlap with wave 1, some know-it-all in the audience is going to call me on that, and then I have to do this anyway. So let me read this very quickly. The most common motive wave is an impulse. In an impulse, wave 4 does not enter the price territory that is overlap wave 1. This rule holds for all non-leveraged cash markets. Futures markets with their extreme leverage can induce short-term price extremes that would not occur in cash markets. Even so, overlapping is usually confined to daily and intraday price fluctuations, and even then is rare. Well, I don't think Bob did that much day trading of the S&P E-mini, because if he had, he would know that it ain't that rare. It happens all the time. But basically he's saying that wave 4 can never overlap wave 1, except that it happens sometimes in intraday futures. Well, boys and girls, that's what we're trading here, is intraday futures. So forget that Elliott wave rule. In my humble opinion, there are exactly 3 hard and fast Elliott wave rules. One is wave 2 cannot retrace more than 100% of wave 1. Wave 4 cannot retrace more than 100% of wave 3. And of the impulse waves, 1, 3, and 5, 3 cannot be the shortest. It doesn't have to be the longest, but it's not supposed to be the shortest. After that, everything else is simply a suggestion or a guideline. Okay? So, this is the 5-minute chart that includes part of Thursday And then this was the end of the daily session. This is the aftermarket. Midnight is about here, Pacific time. And this arrow is showing about the point where I took that first trade. And then the rest of Friday is what you see here. So on Thursday, we were looking at Elliott wave counts, my students and I, in the trading room. And originally I thought that this high here, the one that's marked B, was actually the fifth wave. And I had this as 3, 4, 5. However, the next morning, as I'm looking at things from this vantage point, it looks more likely that this was 5 and what we had here was an ABC consolidation correction, followed by 1, 2, 3, 4. And there we were poised right at that moment. And of course, if wave 4 is the last thing on the chart, there's got to be a wave 5. And we're clearly in a bullish pattern, so wave 5 is going to go up. So I'm looking for a place to perhaps get long. Now, I want to make sure that my wave count here will hold up. So I switched my view to my 1-minute chart to look at this area in closer detail, this area between 3 and 4. And this is what I see. Here's 3, here's 4. It looks to me like we have a 5-wave correction. And trust me, folks, you can have those. So we got A, B, C, D, E. Now, the general rule is, in a corrective move, you're going in a whole new direction. So the waves that are going in the direction of the correction are 5-wave patterns, and the corrections against the correction are 3-wave patterns. And looks like we've got that. 1, 2, 3, 4, 5 to A, B, C for B. Then we have 1, 2, 3, 4, 5 for C. In fact, these, we even have the subwaves neatly segregated in their own little momentum modules. 1, 2, 3, 4, 5. Then we have another A, B, C for wave D. And then 1, 2, 3, 4, and 5 for E, which now completes 4 on the larger time frame. Now, after that, look what happens. We've got a bullish red, white, and blue alignment. We are breaking above the trend definer. We've changed the direction of the larger parabolic. We've got a bullish red, white, and blue alignment on my oscillator. That is my dual stochastic. The MACD histogram is breaking above its zero line, along with the price going above the trend definer. And we have rising volume. Well, there's another way we can kind of verify this, and that is with our trusty regression channel. I draw it from this high down to this low, and look what I see. The first break above the regression channel pushes the Donchian channel upper line a little bit higher, but it immediately recedes back downward, flipping the red parabolic, and then eventually comes back and pushes the Donchian channel higher still. What I see on the oscillator is there's a genuine pullback here where the two-tone blue %K goes above the two-tone red and white %D. That's what I like to see. I like to know that there's a substantial pullback and that we're about to climb on board the beginning of a new upward move. And volume is increasing. So we got good signals in panel 1, good signals panel 2, and good signals in panel 3. And this is about where I got in the trade. And with the benefit of hindsight, we can see we had 1, 2, 3, 4, 5, and here's my wave 5. And got in about here, hit the third target right before the end. And take this opportunity to look at my dual stochastic. The red and white, which by the way is a 5-minute stochastic, is nicely undulating in the same rhythm as our basic large Elliott wave pattern. B to C, we've got red and white above, red and white below. C goes up to D, red and white rises, crosses at about this point, comes back down. So the red and white is undulating exactly in time with our Elliott wave patterns, and the faster 1 minute stoke, the two-tone blue, is giving us more of a clue to the subwaves. So that was my first trade of the day. Now, what happens here? It looks like we've got wave 5 of 5. So if this wave has terminated, what's going to happen next? Well, if I'm correct about my Elliott wave count, and I'm feeling pretty confident that I am, we all know that after wave 5, you're going to have a wave 1 or a wave A, and that means this thing's going to go down. So what do? I draw a Fibonacci grid from the previous large parabolic module's high, which is off the chart, down to the most recent low. That puts the grid in such a fashion that we haven't quite reached the 261.8, but we've crossed the 200. We recede back down, cross it the other way, and we approach the next Fibonacci level. Now, if we cross the second one, there's a pretty high probability that this thing's heading lower. And in this case, as it crosses the second Fibonacci level, which is 161.8, we also flip the red parabolic. Now, in this case, our white MA, our directional MA, is still rising. But about here, the blue crosses underneath the white. And we're just waiting for that white to kind of start curving downward. And sure enough, about the time the white MA breaks out of this regression channel, that's the ideal place to get short. Now we look at our oscillator. We've already had a bearish red, white, and blue alignment since the very peak. And plus our MACD histogram is heading down as well. And again, volume was rising at that moment. Plus it was rising even more strongly on the other 5-minute chart. But here's a perfect place to get short. And I did. Got short right there. First target, second target. Got pretty close to the third, but no cigar. Came back around, and I was ultimately stopped out when the price hit that red parabolic right there. And that was the end result, 1104.50. Now, after I had reached my goal in my personal account, I decided to trade on the demo platform on the computer that you're watching right now. So, is this going to be a good place to get long? Well, let's see. We know that this is probably wave 1 or wave A. We don't know which yet. Now, either way, it should be a 5-wave pattern. Can we see that? Yes, we can. 1, 2, 3, 4, 5. Looks like it's there. Now, I draw the Fibonacci grid from the previous low up to the intervening high, and we find that the price has broken south of the 100 level, but it stops short of reaching 127.20. It goes back above 100, and as it's going above the next level there, look what happens. We get blue above white, we flip the parabolic, and boom, bullish red, white, and blue. What's the oscillator look like? Gee, bullish red, white, and blue, plus the %K is now breaking above its midpoint. And we had rising volume, we get a momentary lapse, and then it starts off again just in time for this consolidation to break above the trend definer, and guess what? Push the upper Donchian channel higher. All looks pretty good to me. I had pretty high confidence that that was going to happen. So on the demo panel, took the long trade, first target, second target, again, got close to the third, no cigar, came down and stopped out when the parabolic flipped here. Now, if this is wave 1, that makes this 2. That means this thing's going to sell off to wave 3. Well, if it's wave A and this is wave B, then there's going to be a wave C. Either way, this thing's probably going to go south. In addition, what else have we got? A 1, 2, 3 top. as we already mentioned. So got short here again. Hit the first target, pops back above, flips the parabolic, but I'm looking at this and I'm thinking, this thing's definitely going to go south. It wants to keep going in that direction, and we're not even really close yet to the upper Donchian channel. So we get to this point and flip the parabolic back to its bearish position, and guess what? Here's the lower Donchian channel line right there. So as soon as I see this thing's ready to push it lower, I know I'm in store for some more points. So there's second target and third target. The next trade came a little bit later on, and I'm thinking, okay, this is clearly some kind of corrective move, but I think it's going to go further south. And look what happened here. I got short at this point. We've got a red, white, and blue bearish alignment, and it looked to me like the two-tone blue was going to cross red and white right there, but ended up getting faked out. We also pushed the Donchian channel lower at that point, but the price didn't drop right then. It had one more bounce to go. Now, I stayed in that trade during that bounce and went in the hole a bit. Why? Because not all mistakes are of the same sort, as I have told my students. Sometimes we're just flat out wrong. We got faked out, and the only thing we can really do is to end the trade, or in some cases even reverse. But another species of mistakes that we make from time to time is we jump the gun. We get in too soon, and the wave that we thought was over isn't over yet, and it has one more little loop to make before the price is going to go in the direction that we believe it will. That's what happened here. Now, why take that loss and undo all this good? I felt that the odds were so high that this thing was going to go lower. Again, look at the upper Donchian channel. It has never been touched. It's been just stair-stepping its way down the whole time, and even here, the price never got anywhere close to it. So it wasn't, even though I was in the hole, it wasn't a big stretch to hang in there. It wasn't fun. I don't like to be, sitting through that, but eventually, first target, second target, and then eventually stopped out here. These three demo trades were worth $1,625.50, again with 9 contracts, 3 targets, and a $6 per contract transaction cost. This was drawn at 6 o'clock. I meant to draw it at 7 o'clock. 7 o'clock was about here. So this second of the trades that I took on my real account would have actually been within trading room hours. But as you can see, and then this was at 12 noon. So all this happened, within the hours that my students and I trade together on Tuesdays and Thursdays. This happened to be a Friday, but you get the idea. Now, if you're interested in joining with us, let me show you this. At the PacificTradingAcademy.com website, if you go to the enrollment link, and again, let me make sure I'm pointing to the right place, the enrollment link, you'll see Mike Bridges Mentoring Course and Trading Room. Click on that and it will take you here. You can read all about the room, how it works, you can see the course outline, etc. Then when you're ready, click the price and payment plan link, and that will take you to this page where you can see what it costs and how you pay. Finally, if you're ready to go, you fill out this information, give it your credit card information. Within a few minutes, you'll get access to the video lessons and how to log into the trading room, and I personally will contact you to set up the first of our 12-hour-long one-on-one phone conferences. Now, here's a quick summary of what you get and what it costs. 3 months access to 9 video lessons, 12 one-on-one phone conferences with me, 3 months of access to the live trading room every Tuesday and Thursday, 5 hours each day. And if you want to stay with us and participate in the trading room after your 3-month course has elapsed, you have an optional month-to-month extension. What does it cost? The all-inclusive tuition is $49.90, payable $29.95 and $19.95 30 days later. if you want to hang around for the optional trading room after the course, it's $100 a month. Also, PTA graduates pay that same amount. Now, $100 a month, there's a minimum of 8 trading room days every month. So it works out to about $12.50 per day, per 5-hour trading day. $12.50 is the value of 1 tick in the S&P. So if you can make 1 tick, you've paid for your time in the trading room. Now, the other thing that you get as my student, in fact, this is the only thing you can get as a non-student. Every day I send out a little email to all my students recapping my personal trading or the trading that goes on in the trading room, and various of my students share their charts with us as well. And so there's always attachments. As you can see, this particular edition, we had 4 charts attached. A couple were mine, and a couple were from one of our students. I want to mention one thing here. In this particular issue, I gave a special shout out to my newest student from outside the U.S., Sam S. of Alexandria, Egypt. If any of you are watching from outside the U.S., understand that you can become a student of mine. Sam and I talk on Skype, and if you have an internet connection, you can join us in the trading room. We talk usually on Skype, but we usually use TeamViewer for screen sharing because it's a little more robust than the Skype screen sharing. But it's great. Unfortunately, I'm not fluent in any other language but English, so if you can speak English, we can work together. And it doesn't matter where you are in the world, as long as you have an internet connection and are somewhat facile with a computer. So if you would like to get a copy of my daily email to my students, all you have to do is let me know, and I will add you to the mailing list. Here is some of the stuff that was attached to that particular one. Now, this was our trading room day that Thursday, and as you can see, we had a positive day, but not by much. It was $64, largely because of this loss here. And now, this is one of the times my aggressive strategy did not pay off. I got long right here as the price appeared to be pushing the Donchian channel higher. It looked like we had a break to the upside. And the fact that we're overbought, by the way, does not necessarily mean that this thing is not going to go higher, because a lot of times you'll get this kind of thing where the price keeps going higher even after the stochastics is overbought. But this was a fake out. Unfortunately, I chose to ride it out because I was fairly confident that the market was going to continue to go higher. It did indeed, but not before hitting my stop. But I was still able to get back in the black by the end of the day. So that's going to happen sometimes. There was also this little trade at the very end. This is usually a little later than I'm likely to enter. I will typically stop trading by 12:30 to give whatever trade I'm in an opportunity to do whatever it's going to do before we have to worry about the first close. But this one last trade was available on Thursday, and it would have made another 321. Now, this you've already seen, I think. If not, this was my personal trading that day. And again, after 4 trades, I was above my $1,000 goal, my grand a day goal. So I knocked off and gave my full attention to trading in the trading room. This trade was from Sam of Alexandria. He's a very good student and plans to trade very aggressively. You can see he's trading 36 contracts here and had 6 winners out of 8 trades. This is our email from Friday. I didn't expect to be able to send one out because I was watching my daughter's medical school match day, and that's where she found out that she's going to be doing her psychiatric residency at UCLA Harbor Medical Center. And I'm so happy because she's been going to school, first undergrad at ASU and then medical school at Creighton University in Omaha. So to have her back home again is making me very happy. Now, maybe you think that kind of personal information is not appropriate for a student mentor email, but one of the nice things about the group that we're trying to put together here is We want to be supportive. We want to be like-minded. I want to have students who are serious about this. And this, again, of course, was my trading on Friday, my personal trading. There's the demo trading from Friday as well. Here's another chart from Sam. 8 winners out of 9 trades. He's doing great. He also tried our technique with a couple of trades in crude oil and had a couple winners there as well. Now, here's a little something I want you all to think about. I can absolutely make no guarantees because some people have it and some don't. But here are my personal goals. I want to help every student become a competent and confident trader with a win percentage of 90% or better. I want to help most students earn enough trading profits so they can pay for the course within 3 months. I want to help some students earn $1,000 or more per day and be doing that within a year. And I want to help a few students earn $1 million in 5 years. I'm very serious about this. Are you interested? If so, there's my email address, mentormike@sbcglobal.net, or you can call the good folks at Pacific Trading at that 800 number, 800-339-8588, or better yet, sign up online as I showed you earlier. Now, I want to talk a little bit about the prospects of making the kind of money I just described. I want to show you my worst trading day of 2014. Actually, I'm sorry, my worst trading week of 2014. This is last Monday in my personal account. I made $1,029.50. Not bad. This is Tuesday. I had a horrendous day. I was out of sync with the market, not feeling particularly well, and I lost $3,536. Now, that kind of money is not going to make me or break me, but it still stings, all right? That's more than my first car cost back in 1967. So believe me, that's still a lot of money to me. Worst loss I've had in I don't know how long. The next day was day 2 of an FOMC meeting day, but I waited until after the announcement, and as the market was settling down, I spotted one good short opportunity, took it, and hit all 3 targets, and netted $633.50. Then this is Thursday. You've seen this, 12:34, and here's Friday again, 11:04.50. So here's how that all adds up. There's Monday at the top. There's horrible Tuesday with the big red. Now, even with that loss on Tuesday, I managed to net $465 for that week. The worst week I've had, not only in 2014, but in a long time beyond. Now, if I made $465 per week, and that's all I made, but I did it consistently for 12 weeks, that's $5,580. Remember, the tuition for this course is $49.90, so I would have paid for the tuition with a little bit left over, okay? Keep that in mind. Now, if you've got questions or comments for me, we've gone over time, so I'll take a look at your questions, but I think you're going to have to email them to me. So if you want to get on my daily update email list or you have other questions, please send them to me at mentormike@sbcglobal.net. Please include your phone number and time zone, and better yet, become my students and enroll directly online. Again, this is where you go, pacifictradingacademy.com. Hit the enrollment link, Mentor Mike Bridges Course and Trading Room. Now, let's see. We've got a mess of questions here. Let's see if I can get this. The question box doesn't want to detach the way it's supposed to. Oh, wait, there we go. Okay. Oh, one of the fellows who's on the current mailing list is congratulating me on my daughter in medical school. Thank you very much, Kevin. I appreciate that. Let's see. What kind of indicators do you use at the bottom of your chart? That very bottom panel, Ken, is a volume oscillator. And we didn't spend a lot of time on volume today. If you go to my blog page on PacificTradingAcademy.com, Mentor Mike's Market Movies. Starting in, I do a webinar, I think it was October 12th of last year, on volume, and just about the succeeding 3 or 4 webinars I did after that, it goes into a lot of detail about volume. The bottom line is, when we take a trade, we want volume to be increasing. We want to be not the only people in the world who think the market's going to go in that direction. You can display volume in a whole bunch of different ways. I kind of like the volume oscillator. It's basically a MACD style indicator, but it's fed by volume data rather than price. Okay, that's all I have time for, folks. Thank you very much for your kind attention. Thank you for hanging around till the end here. Everybody have a great weekend, and I hope to see you all again real soon.